We're talking today about the latest details of the COVID bill that is sitting in Washington, waiting for somebody's signature out of the White House. Right now, it's a $900 trillion. That's right, trillion. That's a big, big number. The reality is that it's not as big as what it could have been and bigger than what it might have been. The reality is it's got a lot of provisions in it. So on the program, we're sort of unpacking some of those provisions in there. You've probably heard about the two biggest ones, which we talked about in the last segment. First and foremost is another round of stimulus checks, where it's like the $1,200 checks that folks got in May or April of this year. The reality is that it's not going to be $1,200, it's going to be $600. The good news is that the dependents are going to actually wind up getting a little bit more, $600 instead of $500. Still some income parameters that exist on that. If you're below $75,000 as a single, that makes you eligible. A married couple or a couple filing a joint return below $150,000, that also makes you eligible for those stimulus checks. On the unemployment side, it's an extension of benefits up to an additional $300 a week through March the 14th. A little bit of a federal add-on, not as much as it was last time when it was $600, but at least an extra $300 certainly helps if you are on unemployment. In terms of other things, there's a bunch of other things in the legislation that is pending in Washington these days, so we wanted to sort of unpack that. Welcome, of course, back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So thank you for joining us today. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So we've talked about the extra round of stimulus check. We talked about the extra money in unemployment. Similarly, in this new COVID bill, there is some rental assistance to tenants. It extends the eviction ban until the end of January of the year 2021. As you might well expect in a COVID response bill, there's also some money for healthcare providers, schools, testing, tracing, vaccines, things like that. So a lot of money getting put towards prevention, testing, and continuation of the vaccines. In terms of business, there's also, of course, some business provisions in there. There's some specific aid to the airline industry, entertainment venues, places really that have sort of been hit by not being able to have large crowds of people. Movie theaters, live venues, there's some specific aid in there for those types of business categories. And then generally for all businesses, there is a second round of PPP money, which stands for the Payroll Protection Plan. That's the piece where it becomes as a loan, but it's a forgivable loan, assuming that you wind up using it to cover payroll and rent and some of the things that the folks in Congress limit the use of that money to. Here's the really big thing, though, on the PPP provisions that are in this next stimulus bill for COVID. And that is this resolution of this issue that we talked about a couple of weeks ago, whereby the IRS had taken the position that if you get a PPP loan and it's forgiven, then you can't deduct the expenses that were associated or covered by that money. The IRS had taken the position and had restated it as recently as probably about a month ago that said, hey, you're not going to be able to double deduct things. You're going to get a interest or a income-free, a tax-free loan with loan forgiveness, and then at the same point in time be able to write off the expenses as well. Well, the folks in Congress actually didn't like that interpretation by the IRS. So this new COVID bill does in fact have specific language in it that sort of overturns that IRS position. So if you got a PPP loan and it's gotten forgiven, then that is income that you don't have to report on your business return. And then the expenses that you used to use that money to cover, those expenses you're also going to be able to deduct. So the power of that loan sort of increases or doubles effectively as a result of the language that is in this latest COVID bill. So along with that, there's some streamlined forgiveness of $150,000. But this notion of clearing up the confusion or the position that the IRS was taking about not being able to sort of double up in terms of the benefit of the forgiveness of the PPP loan, now it appears that the folks in Congress have said, no, we intended that. That's something that we intended, and so we're going to now put it in writing. And it appears that it is in writing in this version of the bill that has passed both houses of Congress. Similarly, there was some changes in terms of charitable deductions. Now, this one sort of got buried along the way, but for the year 2020, you were able to deduct $300 as a charitable contribution without having to itemize. And this is interesting because I think this may be the way or the trend that you're going to see the folks in Washington go to, is giving people the opportunity to make charitable contributions without necessarily having to itemize. Well, they like the idea so much that they incorporated it into this plan and actually doubled it up for a joint return, whereby for the year 2021 you can now do $600 in terms of a charitable contribution and get a write-off on that on your taxes without having to itemize. And that's particularly important because with the increase in standard deduction, many folks find that they're not itemizing anymore. And instead of like a third of the population that was itemizing prior to the Trump tax cuts, now it's less than 7% that are itemizing. So the beauty of these charitable contributions are sort of regardless of these charitable contribution provisions, regardless of whether you're itemizing, you can still make the charitable contributions. And then of course, there's the one that I'm sure you've heard in the media, because this is, just catches people's attention, and that is the return of the 3 martini lunch. Now, I don't know about you, but it's been a long time since I've had 3 martinis, let alone at lunch when you're supposed to go back to work. I did sort of catch the end of that era as a young associate practicing law in DC. That was sort of the end of that era where you would go out to these long lunches and maybe have a cocktail. Unlikely that you get to 2, certainly you don't get to 3, but anyway. The reality is, though, that that's not really part of how business is done these days. The notion of sitting around and drinking 3 martinis at lunch isn't really anything that happens in today's world. So the interesting thing, though, is that they still use that sort of description. Well, it's particularly relevant in terms of the proposed legislation because, this is what they've done in this legislation is they've said that you now can write off 100% of business meals in an effort to sort of help out the restaurant industry, give people a full deduction on it. Here's the reality. It hasn't happened like since the 80s. You've only been, which is probably what maybe killed them, 3 martini lunch, along with everybody's liver, going away. Anyway, since the 80s, you've only been able to deduct 50% of that meal expense. So you always were able to deduct the meals, but only 50%. This legislation changes it back to 100%. Don't confuse that with entertainment. It used to be a 50% deduction for meals and entertainment. The Trump tax changes changed and eliminated the ability to deduct entertainment. So you were just left with being able to deduct meals, but only at 50%. That's how it's been since the 80s. For the next 2 years, 2021, 2022, the proposed legislation in Washington increases that to 100% on the meal side of things. I still don't recommend that you get 3 martinis at lunch because that's probably a really bad idea if you want to get anything done for the rest of the day. But the ability to write off 100% of meals as a business deduction. It appears that it's going to be back after a 40-year absence for the next 2 years. We'll see whether that one actually makes it through, but it's part of the current bill. So anyway, that's the latest out of Washington, awaiting Trump's signature. We expect that to happen. This bill does represent sort of a bit of a compromise in terms of the number of dollars at that $900 billion level. It's still a big number that has a lot of different stuff in the bill that is intended to help people, particularly during this pandemic season that is upon us. Anyway, we're going to take a break, and then when we come back, we're going to talk about 2020 being the year of the time machine here on Dollars and Cents.